Hey everyone, meet Kevin here. So I am super excited because many of you who have been following this channel know I have been pitching life insurance because I've always been confused about life insurance. And honestly, I still feel somewhat confused about life insurance. You know that I've always had this affiliate link, metkevin.com/life, where you can get life insurance in as little as 5 minutes from your phone, Apple Pay, Android Pay. You've heard this a million times before on this channel. Well, Jamie Hale, the CEO of Ladder Life, agreed to come on the channel and explain to us life insurance, infinite banking. I went on Clubhouse the other day and people are pitching infinite banking like crazy. I don't know what's going on. I have a hard time explaining this stuff. So I figured, why not go to a CEO of industry and talk to someone as awesome as Jamie Hale. So I'm going to bring him on right now. Jamie, introduce yourself.
Hey, Kevin. Nice. Thanks for having me. I'm Jamie Hale. I'm the co-founder and CEO of Ladder Life, and we're making it so you can get life insurance as fast and as easy as in 5 minutes.
Awesome. So tell me a little bit, let's get right into infinite banking. What is it? People talk about like, oh, you can make money with it. You should pull money out of this and put it into that. Like, what is that?
Okay. So it's, you got to break down and first understand insurance and life insurance. So what life insurance does, there's a pure insurance component. That's what we do. We do term insurance, which says if you were to pass away, your loved ones will get a certain amount of money. So you can buy, for example, $1 million policy that may cost you like $50 a month, right? Yep. And that $1 million policy, if anything were to happen to you, people are counting on your income. That replaces your income and makes it so they don't have financial distress, or at the same time they're having like real emotional distress, emotional suffering. Right. I'm passionate about it. My dad died when I was 11, and he had a simple life insurance policy. Yeah, no. Listen, hugely redeeming role in my life. It got me through college, got me through Harvard Business School. Like it got my mom and me in our home around our friends and our family and our community during a super shitty time. So it's a great product. It's a really act of love. It's wonderful. It's like stock diversification. It's a low probability, and it really helps you. Okay, so you have term insurance, which just pays, it's just the pure insurance side. And then you have whole life insurance, which is a combination of two things: term insurance, just the pure insurance part, and a savings account. So infinite banking has to talk about how you can use the savings account aspect of a whole life policy and different ways to access it. I can go on forever about infinite banking and get into the real details of it if you want. One thing I think most people get.
The savings account, is that where people talk about like, oh, this is where you can make interest on your money, or and are there a lot of fees that go into that, or what's the scoop with that?
Sure, there is. So first of all, there's a lot of fees that go into most whole life policies because they're sold through a pretty expensive distribution network, which is life insurance agents. So if you for example, a whole life policy will cost sometimes 10 to 20 times as much. So let's use 10 times as much. It sometimes will take you 20 years of payments before your cash value inside your whole life policy equals the premiums you paid in. If you were to take that same amount of money and just put it in a savings account or brokerage account or invest in real estate, right? That money would also be working for you. And in a whole life policy, by definition, you only can invest in bonds that the insurance company owns.
Oh, wow. Okay. So the whole life policy is really designed to be something where maybe rather than paying $50 a month, you're paying, say, $200 a month. And the theory is that they're going to take that $150 and help you build that wealth, essentially, the value of your policy. And you're saying because there are a lot of fees that go into it and your investment options are limited, you might be better off just literally taking that extra $150 a month and going buying Tesla or something, or an S&P 500 index fund.
Yeah, you can. There's a lot of complexity when people talk about infinite banking. One of the things I think that's most misleading is they talk about you can pay yourself when you borrow. You can borrow against that cash value, and it's tax-free, and you're paying yourself. Well, let's say I own a home or a second home or an income property. I can do a home equity loan against that. That's again a tax-free withdrawal of the value of the asset. It doesn't cost me, but I have to pay interest. That case, I have to pay interest to the bank. If you withdraw a loan on your whole life policy, you have to pay interest to the insurance company. You're not paying interest to yourself, you're paying it to the company, right? So you're literally paying the company to access your own money.
Right.
So that's usually not a good deal.
So, infinite banking, how does this, like, how do they take a total novice and explain this? So if I'm totally clueless about infinite banking and I say, okay, I get that I can have a life insurance policy for $50 a month. It's term. I pay that, I get my insurance. If I
Yep.
die, I get paid out whatever, right?
Yep.
Following the terms of whatever we signed up for. So whole life is now I'm paying more money. I'm
Yep.
paying into basically an investment vehicle. And the theory
Yep.
is I'm going to grow this. So
Yep.
let's say I grow this to, I don't know, $50,000 as an investment vehicle. The infinite banking, are you suggesting the infinite banking portion is people like borrowing against that and kind of paying
Borrowing
themselves against
against,
their?
yeah, they're borrowing against that and quote unquote paying themselves, but they're paying interest on that. And that interest is not going to them. It's going to the insurance company. So you need to make sure you're comparing apples to apples. A lot of people who talk about infinite banking will assume you pay $50 for term, and then the rest of the money that you save opposed to the whole life policy, you just spend. You don't actually save it.
Hmm.
So if you're looking at two components, you can either bundle them together, a term policy and savings in a whole life policy, or you can do it as a term policy plus a savings account where you put it in your 401k, buy Tesla, buy S&P 500, or buy a money market fund. And if you compare those two apples to apples, that's where I think the true comparison lies. And a lot of times, infinite banking, given the fees, given the expense of borrowing against it, a lot of times doesn't make sense financially.
Got it. Here's a question in the comments. Can you
Yeah.
comment on this? They're wondering, they want to talk about mutual companies and dividend payout rates at 6%, with distribution that's tax-free. So where does that come from?
Yeah. So these mutual companies, you can buy a whole life policy that has a return of their underlying assets. And they've been investing in those assets for a long period of time. So you can then put money in and kind of participate in it. Those 6% aren't guaranteed. And when you look at 10-year, yields at like 1.6% now, right?
Yeah.
Those are long-term historic averages. And if you look at long-term historic averages for any bond, those are higher in past history than they are today. So those aren't guaranteed distributions. They'll just say, if we do well, we'll pay you a distribution. There's a lot of 6% dividend paying stocks too, right? So like you have to think through if you're thinking through your financial life, you got to think through all your different alternatives and what's going to make sense for you. And for most people, they want to have real liquidity. They can act, if you have it in a savings account, you get it anytime you want. You have it in your brokerage account, you get it anytime you want. For a whole life policy, you got to hold it a long time, just even to build the cash value that you can then borrow against.
So sometimes I hear people, they say, oh, you should mortgage your house and put this money into this whole life plan, and then you could get, a return. Are they selling this with the idea of basically trying to arbitrage? Like, hey, you can get a loan on your house for 3%, put it into this fund that hopefully pays 6%, like an AT&T stock, let's say, that pays you 6%.
Listen, there's a lot of ways you can leverage your assets and leverage them between other things. I am the biggest life insurance fan there is. I don't do that. It's because they aren't guaranteed and it's illiquid and you have to pay a lot of upfront fees, right?
Talk about those. What do you mean it's illiquid?
It's really hard because what you basically do is you have a big surrender cost. So if you were to say, hey, listen, I want to cash out my policy, a lot of times you can't cash out your policy and get your money back for what you paid in until usually well north of 20 to 30 years. So it's like having a big, I'm going to be really old school. You remember A-share mutual funds? They charge you this big upfront fee to buy the mutual fund.
And then they charge you a big fee to, there's an upfront fee to actually buy into it. Okay. So it takes you years to actually make your money back.
Exactly. So that's usually why a lot of people are looking at, for most investment stuff, they're really considering kind of low fee alternatives.
So if somebody is looking into infinite banking or whole life insurance, they should also they should not just look at that maybe 6% yield, but they should also consider, hey, if you wanted to cash your money out, you've got to pay this surrender value. And you might have to have your money in there for 10, 15 years before you even break even on that, is what you're saying.
Yeah, exactly. You should look at, you should check out your affiliate link at, meetkevin/life to see what a term policy will cost you. You can go to ladderlife.com, right? You can see what a term policy will cost you, and then say, hey, how much do I want to both protect my family and get a death benefit of $1 million, or how much do I want to then additionally save? And if I want to additionally save, is this whole life policy my best choice, or is a brokerage account my best choice? Is a savings account my best choice? You can look at all those different options.
And then somebody here says borrow against cash value in policy in form of a loan. So when you borrow against the cash value in your whole life, you're paying. It's not like a retirement account where you're paying interest into your own policy. You're paying it to the life insurance company.
To the life insurance company, and it's just like if you were to borrow on your home equity line, you're paying your interest to Wells Fargo. Now, Wells Fargo, if they make a lot of money, they may raise your dividend rate, and you happen to be a shareholder in Wells Fargo, then you may benefit from some of that. But you're not paying truly yourself, right? You're not actually paying it into yourself. So that's any loans you can borrow against your assets. You can margin your loans in your stock portfolio. That tends to be cheaper than getting a credit card loan. So it all depends on how you want to manage your liquidity and tax. I used to work for a couple of billionaires, so I know a lot about like asset location and tax minimization, and those things typically don't tend to work. It tends to cost you more than it's worth.
And is there a limitation on what you can invest in if you do a whole life infinite banking concept? Because really the infinite banking is just really a creative way of saying you get a dividend.
Yeah, you get a dividend, and that you can borrow. You have an asset because you have a savings account. You have an asset you can borrow against, right? But you can accumulate that asset any place you want, and you can borrow. Usually, you can borrow against most of those assets or sell them. It's harder to get the cash out of a whole life policy. That's really what it's talking about.
There's a comment here from Mark about you can prepay future premiums and stash away more cash than just a 1-year premium. Great avenue for wealthy individuals. Is that like a tax deduction thing here, or can you speak to that a little bit?
No, it's not a tax deduction. It's you can front load a lot of premium into whole life policies, and whole life policies are basically a way to avoid paying taxes on current income. A whole life policy has to be invested in the balance sheet of the bank. The bank's balance sheet is, the insurance company, and the insurance company's balance sheet is regulated by the NAIC, the National Association of Insurance Commissioners. And basically it's like a 90% bond portfolio, some real estate, some other things. So
REITs, some real and bonds.
Yeah, you can replicate that yourself if that's the type of investment asset you want. And you could front load into a personal account as much of that fixed income as you want. If you have a 401k that's not 100% fixed income, you're probably, because what you can do is then defer all current income in your 401k and take your equities and hold that in your personal account. You can defer that for a long time. So this concept of you being able to put in as a lot of money as you want, most savings vehicles allow you to do that as well. In insurance, it actually gets slightly technical around inheritance tax and whether or not you're really creating a generational skipping thing.
Because
so there's some tests.
Is there a stepped up tax basis in these?
It gets really technical. It depends.
No worries.
It depends on how it's structured and if it's in a trust. Yeah.
I see. Okay, because that becomes a big issue, because that's even an issue with retirement accounts. People have retirement accounts. They're like, I did so well. I kept all my money in this retirement account, and then somebody passes away and somebody goes to inherit a retirement account, and it's a nightmare to transfer. But then they don't get a stepped up basis, and people are like, what the heck? They may as well not put it in a retirement account.
Yeah, that's a different discussion. That's kind of tax policy. But I think, coming back to just term life insurance, this is about if you have people who count on your income, right? If you, are a dad or taking care of your mom, or you have a charity you want to take care of, and you don't worry about, living long enough, it's a really cheap way to make sure that they get protected. And, what's nice is for ladder, we go everything from 100,000 all the way up to 8 million, which is kind of the high end of the market. So kind of regardless of who you are, we can get you covered. And for 10 years to 30 years, so really, really nice long durations too.
Locks it in for that. What are the commissions like in whole life? I mean, I don't know the incentive structure and like the whole life and the infinite banking. And I guess if there was a more transparency on that, like, a realtor, it's like realtor wants to sell me a house. Well, of course.
Yeah.
There's a, a two
No.
and a half, 2.5% commission in there. Are there
The
big commissions in the whole life?
the commissions can be very, very high.
Okay.
If you were to look at the surrender costs and like
Mhm.
look at the premium you paid and the surrender costs, a lot of times that comes to a close approximation to what the commission some agents are making.
Hmm.
You
Oh, wow.
definitely can be buying someone a car in certain circumstances if you're buying a big policy. So
Oh, wow.
that's because of that, you just need to be careful to make sure that that's exactly what you need. So this is something we really should look at all the fine print, really look at all the
Mhm.
schedules. Don't let people do air math, right? Because they're going to forget parts. Like really look at all the details, read the fine print. It could be a good choice for you, but it's pretty rare, right? It's pretty
Okay,
rare.
and that's exactly why I wanted to have you on. I mean, obviously, you're at Ladder. You don't do infinite banking, but it's so good. See, like I feel like as if I'm in a certain industry, I
Yeah.
can also talk about what the competitors have
Yeah,
going on, and then hey,
sure.
maybe I got to talk to an infinite banking person next, right? But
Sure.
I'm so interested in this perspective. So the surrender value is a big issue. Commissions are probably invisible really to the front user, but you're really being
Yeah.
essentially sold on that, which is fair. I mean, sales
Yep.
isn't necessarily a bad thing.
Sure.
But the concerns are real here. I mean, if you got to look in the surrender value, the continuity of that dividend, could you get
Yep.
that dividend from something else, and what kind of
Yep.
fees are you paying? Are there like, funds usually have like a 2% management fee? Do you get that with this as well?
Yeah,
Like,
I mean, yeah. So there are a lot of things go into how they calculate what the return is going to be on your whole life policy, and there are things like how good their portfolio returns, uh,
mhm,
the cost of what they call the cost of insurance, which is the cost of the mortality of their overall book. So
mhm.
these are not guaranteed return products. So they'll illustrate a couple of different things to you. They'll illustrate what's guaranteed. They'll illustrate what they hope they'll be able to achieve for you. And I would just say, just like with anything else, just be really careful. Read the fine print. Think about the fees. But it's not uncommon for a whole life policy to pay a $20,000 or $30,000 commission. So as you
Oh,
think about
wow.
uh, that's a lot of money you're paying this person to help you get this product. You should make sure it works 100% for you and it's not better than something
Mhm.
else. Because there's a lot of good Vanguard funds that don't charge that.
That's a good point. You almost wonder, like, if you're going to look into a whole life policy, infinite banking, maybe compare that to what you might yield on a Vanguard fund. Because in
Yeah.
theory, I mean, if I grew a $100,000 portfolio over time, and I invested that into AT&T, and I got my 7% dividend, and I didn't have to pay any
Yep.
fees or whatever. I mean, that all of a sudden works out to passive income of $583 a month for me,
Yep.
and I'm not paying fees. Is
Yep.
that kind of the same sales principle
Yes,
they're doing
yes.
with Infinite?
That's what they're saying. And they're saying, listen,
Mhm.
that dividend you're going to pay current income on, you're going to pay a
Yeah.
tax on that. So tax adjust that. And this is going to grow inside this vehicle tax deferred. Now, if
Mm.
you can put your high dividend stocks in your 401k and have those grow tax deferred as well, and have your lower dividend yielding assets in your personal portfolio. Asset location is a term people use when they talk about how to optimize your tax. So a lot of the things people will talk about in infinite banking, they mix a lot of concepts together that if you break them apart individually, don't always make sense. So asset location is one thing you want to think about when you think about your personal portfolio. As you think about, I mean, the reason we create laddering it's in our name, ladder. Your life
Yeah.
insurance needs aren't constant over time; they change, right? You get a mortgage, called $1 million mortgage. Maybe you make 2 payments a month, right? So
Right.
you're taking that principal down really quickly, right? You can then, with ladder, since we charge you no fees, we're one of the only people that charge you no policy fees. You can reduce your coverage. Let's say you reduce it by half over time. That's going to save you half of the price. The price is going to get cut in half, right? So your needs change. You have a second kid, your need goes up. You could log onto your customer portal and literally push the up arrow. Will underwrite you instantly. You can buy a second policy right away, right? So we wanted to make it dynamic because as you keep your needs, as you look at your liability curve and keep your insurance coverage exactly right, you can save 50, 60% over the lifetime of your insurance by really not overbuying, getting this big block of insurance that's really inflexible. You've paid a lot of fees for it. You can't change it. That's really the old school way. Like that's like literally the 1950s way, right? Modern technology can make it way easier.
And I want to talk about your technology. In fact, I just want to highlight this comment here. If I need a lawyer and a CPA to buy life insurance, then it's too complicated. I have to say, one of the things that made me really like hesitant about ever looking into life insurance was it's so complicated. One of the things that I loved about your company, which is one of the reasons I signed up, because I signed up at your company before I was ever an affiliate. It was totally just like I reached out. I'm like, wait a minute, this was way too easy. And the reason it was so easy was Lauren's got asthma and allergies. I don't, but I think we filled out the form and in like 5 minutes, like I was approved right away. Hers was like approved within 20 hours. We didn't have to talk to anybody. Nobody had to come visit us or anything. It was easy.
Yep. And that's
like
what's amazing. 70% of our customers just love it because it's easy. It's literally, it fits in your pocket. It's on your phone. It's 5 minutes. We have people who tell us they got it in a grocery store line. But more importantly, if you want to talk to someone, all of our customer service agents are licensed agents. That's really unique. They're all licensed life insurance agents, and 0 of them are commissioned, right? So they are not there to sell you something. They're there to answer your questions, right? Because it can get complicated, and people they want to know they got the right thing for their family. So we're there for you. And yeah, listen, that comment about a CPA and a lawyer, when people start throwing around a lot of different terms and we can talk really geeky, you should slow down and make sure you really want what they're selling.
I was almost going to do a defined benefit pension plan at the end of last year because I would have been able to write off more money for my taxes. But I'll tell you, once I started going through like the 20-page contracts and I got to pay for a minimum of 5 years, and then there could be excise taxes. It's like, once you get it seems like anytime there are these creative programs, they're very complicated. Like you have to be an expert in it to really be able to nail it. It seems like.
Yeah. So listen, there's a 1% of people some of these things make sense for. If you're in the 99%, you have less than 20 million of assets. Almost under every circumstance, a really strong term policy like what we sell is going to be great for you. And then you get to live your life. You get to know, hey, your people are taken care of, and I don't need to worry about it. Like life is simple. I can go forward. And you want to again, you crush it on one of your investments, Kevin. You no longer need it. I'm a big fan of retire early and be financially independent, right? You crush it. You don't need this anymore. Great. We want to make it so easy. You can just press a button. You're done. No surrender charges, nothing. You're done. Great. Wow. We're glad we took care of you while you needed it.
Well, thank you for that. So I got to ask you, Lemonade, okay? Lemonade Public.
Yes.
They just came out with life insurance. What's going on?
Oh, big fans of Lemonade. I'm excited. It's going to sound counterintuitive. I'm excited. Part of our mission at Ladder is to drive there to be more accessibility to life insurance, to strip out all the costs and all the BS process and make it really easy for people to get it. Most of what Lemonade does is they're a property and casualty company. So most of what Lemonade does is protecting stuff. Right, your
renters,
apartment, your condo, your pets. So they're selling someone else's product. So that's new and unique for them. And it only goes up to $1 million, and it's only 10 or 20 years, your 2 choices. Most of the time, it's more expensive than us. But listen, I love the competition. It's going to keep us on our toes and raise the stakes. And let's please come in. What people don't understand is how big the life insurance industry is. Renters is a $5 billion annual premium market. Life insurance is a $750 billion annual market. God. It's just so of course they're graduating up. They've done such a good job where they started, and they're going to graduate up. And
what do you mean they're selling somebody else's product, and how does that compare to you?
Yeah. So what they are is they're an agency. And so they just like any other agency. What
they're brokering.
They're brokering. What's unique about us is we are what's called a program manager, so we've designed all our own products. We've worked with our underlying insurance companies to get them filed and have unique rates and come them out in the market, so we can give that beautiful experience front to back. And we built the whole tech stack, right? So Lemonade has not yet built a tech stack in life insurance. They built the full tech stack, so we can give you that 5-minute beautiful experience.
I see. How much does artificial intelligence enter your business?
We definitely leverage data and leverage data a lot of ways so we can help you understand like what's right for you and also make our decision really fast. Way most life insurance companies do it is they have you fill a lot of paper. And believe it or not, that actually creates a lot of costs and creates a lot of errors, right?
Yeah.
You're gonna fill out your application way better on your phone just typing in directly than you will like literally writing out a paper application, like scanning it and faxing it somewhere, having someone else rekey it. So we leverage all that data to give you a really good price instantly. And we're trying to make life insurance a lot more accessible, a lot fairer by stripping out these costs.
I want to ask you, because Lemonade might not tell us, do you think, and you might not know, but just to speculate on it.
Yeah.
Is it possible that, see, Lemonade's algorithm, they say, oh, we're going to track like for renters insurance, how people fill out the form. Did they read the terms of service and that? And then they use reinsurance for like 75%. Is it possible that they take, some of the people that they're like, they seem a little riskier, let's give them to the reinsurer? Is that possible?
I happen to know the reinsurance market in general. I wouldn't worry about that. That's not probably not. And the Lemonade team is a great team. So they're gonna, if someone's really trying to game the system, they're gonna probably not offer them a policy, opposed to collect a commission and stick it to the reinsurer. That may make that may make you money for a day or two or a week or a month or a year, but it's gonna catch up with you. And
good point.
Just like property and casualty, Daniel and Shai and the Lemonade team, they're trying to build, $100 billion company that lasts 100 years. We're the leaders in life, and we're doing the exact same thing. So we're all really focused on getting it right.
Got it. This is so fascinating. Yeah, and I'll have to, if somebody knows, or maybe you even know somebody, if somebody knows a whole life person, I like creating debates on the channel. We'll have to have somebody on to do the whole life side, and I'll take your critical points and we'll put holes in their argument. So I want to know this, and I know I got one or two more questions here. We got to run. When are you guys going public? And are you going to do a SPAC, direct listing? Come on, let's hear it, man. When can you give me some shares before it happens?
We're not going to announce anything here. We are doing really well. We had a great growth year. Thanks for saying that. We are happy just doing what we're doing for now.
Okay.
But the SPAC market is pretty interesting. It's basically late stage, private equity, venture capital, and it's exciting. It used to, the stock market used to be a place where companies could go public early and really develop. You look at Amazon, you look at some of these other really early companies that went, and it's changed, and maybe SPACs are bringing it back. It's going to be interesting to watch.
So you like the SPAC process? You're like, because a lot of people come out and they're like, SPACs, people lose money fast. They're speculative. Are you actually more bullish on it?
Listen, they are buyer beware. They're speculative. And not every SPAC is created equal. Look at the management team behind it. Look at what their incentives are. The incentive structures of the management teams are very different, right? So you want to make sure everything aligns, but there are some real advantages to private companies going public via SPAC. All the paperwork's done ahead of time. You can go to the market much faster. The challenge is you don't have that IPO bookmaking process where you match up your long-term investors with, your company. So what happens in the SPAC is those shareholders all have to trade out. But that's what the markets are for. So if you have the investors who bought into the SPAC around the strategy at which you as the target company match, like it makes some real logic.
Last question: when are you getting into homeowners and renters insurance, or is that not in the?
We're not going into the P&C market. We are looking to redeem every single product in life insurance. So in annuities, we think there's an enormous opportunity to make a better annuity by using technology and taking out the costs and making it much more accessible at much lower amounts, much lower fees for customers. We do think there's a way to redeem whole life in a really wonderful way, right? To take out a lot of those costs, a lot of those commissions, and make it something that's really, really easy that you can own in small quantities and grow over time.
And that might be like an investment product, essentially, that somebody could buy through your platform or something like
exactly. Exactly. Think of it like a term product married with a nice bond ETF.
And you would pay in upfront into it's kind of like you take your cash value, put it into that, and then you get your dividend kind of thing.
Yeah, exactly.
Got it.
Wait, there's a lot. Yeah, thank you, Kevin.
Yes, go ahead. Say what you wanted to say really quick.
No. Listen, we got a lot. We got a lot we got to do ahead of us, and we're excited for our early start.
Jamie, this has been awesome. I'm got to take up the challenge now, and I got to hit up a whole life person. And you gave me, I took some notes here. You gave me some things to poke holes in the argument, so I really appreciate this. And it's been fun partnering with you over at Ladder Life. If you watch this and enjoy this, I personally Apple Pay with Lauren for my Ladder Life policy at metkevin.com/life. Link right here. Yeah. So check that out if you're interested. It's really cool to be able to talk to you. We'll have to have you on again sometime in the future, maybe when you launch that annuity.
Well, thank you. It was Kevin. We're really happy you guys are in the Ladder family, and thanks for having me on. And talk to you later.
Perfect. Stand by 1 second. Everyone else, thank you so much. We will see you next time. If you've enjoyed this, consider subscribing and sharing the video, and we will see you next time.